Welcome guys to video 3, which is understanding in depth the major emotions of Forex trading. It's crucial we understand why we react the way we do, since the first step is acknowledging it to enable us to change it. We need to understand that we are within a limitless environment, where anything can happen at any given time. Trading Forex really has no boundaries, which is why people struggle so much to form their own boundaries when trading the markets. Forex trading can be so rewarding, with no cap on upside potential. But like with most other things in life, whether that's society, school, driving, or working within a job, we have been given boundaries. We are given set rules to abide by. Whereas Forex trading, it's all on us to define and create our own rules and boundaries, our own self-control to stay out of trades which do not meet our rules, or provide a higher reward relative to risk, and to stick with these rules regardless of emotion. We have to understand that all the rules we know today about the world, for example, to not drive on the other side of the road, to not go over the speed limit, to not steal from shops, this was installed into us from a young age by our parents or society. We weren't born with these things already there, hence why other cultures and countries do things different to us, which we cannot understand. Like any other game we participate within, either a card game, football, an Xbox game, everything has an ending. It has rules. Even a cigarette has an ending. From the moment you light it, smoke it up until the point it hits the filter and the tobacco has run out. But trading has no ending. Prices are constantly moving. Your buy or sell begins when you want it to begin, it finishes when you decide. Regardless of the plan you had for that particular trade, from the moment you click buy or sell up until the point you either manually close it, take profit or get stopped out, numerous emotions can take place. Greed, fear, changing your mind, reading something somewhere of someone having the opposite bias. These things can cause you to act irrationally and without logic, which is why it's key to understanding our emotions and our own personalities. Forex trading and the mental structure and control of our emotions when dealing with this particular profession was not given to us. It wasn't drilled into our brains from the day we were born. We weren't told over and over again from 3 months old. No one has given us these rules or shown us how to handle ourselves in a live trading environment. If anything, our parents, friends, and society actually push us away from taking risks. They encourage us to play it safe, save our money conservatively. Heck, some people's upbringing by their parents has been so bad you can come across people daily who cannot function in society or do not know how to handle their emotions with general life, let alone trading. Which is why it's important to be in a sound mind when venturing into this potential rollercoaster of a ride, because Forex trading can be a curse and a gift. Consistently profitable traders always define risk in advance because they are aware of the environment in which they are trading. Really, this is what trading is: defining risk and creating rules. Inconsistent traders who lack regular profitability struggle to confront the reality that each trade could go either way and could result in a loss. No matter how many conferences you have or how good the trade may look, the trade can always still result in a loss, which is why it's important to build the mental structure and strict discipline with our risk management. Otherwise, no matter how much the trade looks like a win, the loss can wipe our account entirely. We can never fall victim to believing that a trade cannot lose. Protecting our capital always has to be the top of our priorities. We need to learn how to take ourselves out of the trade and ensure we are always making decisions based on our best interests and taking responsibility for our own actions. This means if we find ourselves in a losing position, we shouldn't try and keep that position going in the hope it will turn back to break even or an amount we are more comfortable with losing, which is why stop losses and managing risks are essential to survival and longevity. Trading is about integrity. Integrity is when we do things which we know are right regardless of whether anybody's watching or not. Just because you can do something doesn't mean you should. If you knew you could do something bad or wrong and get away with it, would you still do it? Just because something is freely available, such as chocolate, does that mean you should just eat it all the time? Sure, you could lie to everyone and secretly say you are not eating it, but what does this do to your own self-confidence when you keep going back on your own internal dialogue? This is the thing with the markets. The markets do not care about you. You could put your entire account on shorting GBP USD, but does that mean you should? You can fake it to others, sure, but when it's you versus the market will always win and catch you out unless you define your rules, Stick to those rules in the face of anything else and do the right thing regardless if people find out or not. Everything within Forex trading is about self-control and restraint. The longer you can stay in the market, the longer you have to stick around long enough to master it. Forex trading is very much about accountability. I can remember when I was in school, I would be woken up by my mum who would come into my room the same time each morning as I had to be at school for a certain time. That was the rule. When employed, you have to be at your job when your boss tells you, or you lose your job. But what happens when you're a Forex trader or an entrepreneur? Who wakes you up at 9 a.m? No one is telling you what to do, where to be, which currency pairs to watch, which moving average to use, when the best time is to place a buy or a sell. We have to wake ourselves up and find the motivation by ourselves. This is why BSAP's FX course was created. Because I needed to cut people's learning curve in half and fast track them through education and provide a clean-cut, simple system which can easily be applied and show you the rules you need to abide by. I have done the backtesting, I found the confidences which work best together and in which circumstances they work best. I have provided the knowledge on how to enter the market, how to exit the trade. Regardless of this, I still cannot control how much my members choose to act on this information, or when they choose to revise or get themselves out of bed. We still must learn self-discipline, emotional control, and a strong mental structure. I could give you a free trade today, but would you necessarily take it? You may have lost 2 trades already today, so maybe you're staying out of the market. Or you could have lost 2 trades, so maybe the free trade I give you now, you're hoping will revenge trade the last 2 you lost. But what if this free trade goes the wrong way also? I wouldn't be bothered myself, because my rules on strategy and risk management means I win long term. But have you personally got all of this in check with your trading? Which is exactly why signals and quick fix trades which cut corners and lack showing you how and why the trade was generated, will never provide consistent profitability or self-confidence. Regardless whether it's your own trade or you took my trade, every trade has an outcome for which you are responsible. Very few people are willing to accept the responsibility. It was not Donald Trump tweeting which margin called your account, it was your lack of preparation and disregard to managing risk, which if used would have taken you out of the trade and preserved the remainder of your capital. 3 of the main things new traders repeat over and over is random trading, trying to pick tops and bottoms, and listening to others, all of which can be removed. I personally know traders who have spent hours analysing a currency pair and planning trades for the week ahead, and then instead of placing the trade they had set up, they do the complete opposite and take trades based off someone else's analysis or some signal from a Telegram chat. Majority of the time, the trade they had planned out for days turns out to be the best trade they could have taken. This is a fine example of how one can lack confidence and therefore randomly trade based on very few confidences, lack of confidence, and a lack of discipline. New traders do this because they do not want to take responsibility. It's easy when you take someone else's trade, you can pass blame onto that person or company or the news. When you take your own analysis, it's you telling you that it was your call if it goes either right or wrong. How can we overcome this? Well, I've already covered comparison, learning phase solitude confinement within video 2, and tips on building your own confidence. But most importantly, we must prevent random trading and attempting to pick tops and bottoms simply because price is high or low. Going against momentum is one of the most damaging things you can do to your trading account, mixed with no risk management creates a recipe for margin calls. The consistent, profitable trader probably does not entirely exist right now within you. Regardless of how successful you may currently be in other areas of your life, fitness, your own business, or within your career, this is completely irrelevant. Why? Majority of successful people have had a huge success because their achievements so far to some extent have been down to how they can manipulate and control their social environment, the food they eat, and how they choose to respond to problems within their life. Every person on planet Earth has learned ways to make their exterior living environment match their mental interior environment. This is difficult to replicate into an unforgiving market which cannot be manipulated by you and where you cannot control anything the market chooses to do. The market does not know who you are and has no care whatsoever for you. The only thing we can control is our perception of the market information and our behaviour when participating within the market. That's it. That's all we can control. Instead of fighting against what we hope or feel the market should be doing and trying to control a $5.3 trillion market, we can learn to control ourselves. We can create rules, understand our own emotions, journal our mistakes and lessons, protect our capital, and begin moving forward in ways which align with our best interests and personality. We have to sculpt ourselves into the person we need to be to fearlessly participate within the markets. So let's cover some of the main mistakes traders regularly do and how lack of acknowledging the mistakes can form bad habits. Trying to avoid the unavoidable, which is a loss, is what's preventing you from excelling within Forex. Losing money and being wrong before you become a Forex trader are both equally as painful, which general people in life work hard to avoid. But each trade we place involves being wrong and the potential to lose money. Therefore, accepting risk and accepting losses is the true skill set within trading. We need to find a balance between not getting into trades too early before the market has met our rules and generated a solid signal, or too late after the rules have been met, which then results in a smaller risk to reward ratio and a poor entry. The sooner you manage risk, set the percentage you are consistently happy and comfortable with losing, the sooner you can avoid larger losses which eat up your capital and knock your self-confidence. The best traders in the world are not afraid of the overall outcome because they have already developed a winning attitude which allows mental flexibility to easily flow in and out of the Forex market based on what's actually happening in the market. It's key for us to recognize what's holding us back through journaling the process, being self-aware of our actions and habits, and resolving conflicts between what you want to be and what you currently are. Removing the social environment conditioning you have been victim to your entire life. Learning how to think and act contrary to our existing beliefs about money and losses. We need to identify the patterns which make us lose money. Once we are aware of the patterns, we can work to overcome them. I will now show you some examples of things new or inconsistent traders do which ultimately form bad habits. Understanding greed. Greed will stop you taking profit, meaning you stay in trades too long with optimistic take profit targets as opposed to setting realistic and conservative take profits based on the rules of your strategy. The saying goes, bulls make money, bears make money, greedy pigs get slaughtered. Greed can also dominate your trading when you choose to over-leverage yourself or overexpose yourself to a particular currency. As covered in Risk and Live Trade Management video, I would also encourage you to look at which pair you have your portfolio exposed to the most. If it's the euro, I would suggest for you to diversify your invested capital into others such as USD, JPY, GBP. Here is an example on the chart of how greed kicks in and builds a foundation of repeat habits. This is a chart showing a great entry based on the strategy I teach within BSAPS FX. The actual strategy is irrelevant right now. This example is just to simply show greed. Now let's say you set your stop based on your risk management percentage and you set your target take profit automatically based on your strategy. This is a 1 to 6 risk to reward, meaning you are risking 1% of your capital to gain 6%. Let's now take a look at what happened in the next image to see how the trade played out. This is now the trend in the future. Once your take profit was hit, you can see price continued and actually went for another 160 pips, which is double the amount you took. How would something like this make you feel? Knowing you made 150 pips, but the market moved an additional 160. Especially if you had maybe lost a few trades this week, you'd be left thinking, if I'd held that trade, it would have made up for the losses this week. This thought process creates bad habits and means you begin changing your rules through greed. So what happens on the next trade? You set your stop loss and risk percentage, but this time you tell yourself you will hold the trade even further, because most of the time the trade seems to go further than your strategy take profit. Below is an example. Usually, based on your strategy, you would have taken profit where the call out says so, but you want to push it a bit further, so you automatically set your take profit lower and you tell yourself no matter what, you're squeezing as much as you can on this trade. What happens next? It's unlikely you are monitoring price. since it's unrealistic to always be fixed to the charts all day. So on this occasion, by the time you'd come back to the charts, you would have seen most of your profit had disappeared and you're almost back at the point of entry. If only you'd stuck to your trading plan and strategy and taken profit where your rules state. You should never feel regret or ashamed about taking a great risk to reward trade and the trade going further in profit than you had thought after closing it or taking profit automatically. Traders put a lot of emphasis on holding trades for hundreds of pips because they plan to be a swing trader, for example, or they simply just want more pips or money out of their trade. This makes sense, and with some trades it's easily achievable. Reality is, if your strategy this particular trade tells you to get out at a certain level, and this take profit level equals a greater risk to reward than 1 to 2, then great. This is good news and is worthy of a pat on the back. The trader never went broke taking profits which were more than double their risk exposed. Sure, you can go broke closing trades early, which I'll explain in the next emotional step, but taking profit which is double the risk amount is never a bad idea if that's what your rules tell you. Understanding fear. Fear, in my opinion, is the most sabotaging emotion within Forex trading. Fear causes us to take quick profit as opposed to holding it to its full target. You can go broke taking quick profits. Fear can cause you to not take trades in general. The key to successful trading is to make more than you lose. You need to allow your winning trades to reach their full potential based on your strategy. Below is an example of how you can have a high win rate but negative expectancy and no profit. Out of 8 trades, the trader wins more than they lose, which is a high win rate. The issue with the above is that the trader, when he loses more than he wins. This is from taking small profits. I will illustrate this within a chart example below and how doing this can form bad habits. This particular trade, for example purposes, is a 1 to 2 risk to reward. You are aiming to risk 1% to gain 2%, which should always be the minimum you shoot for when taking trade setups. As you can see, the trade was going great. Before the trade takes profit at 2%, which is your target, the trade goes to 1.4% profit and then returns back and ends up stopping you out for a 1% loss. So you take the 1% loss and move on to the next trade setup. Say this happens 3 times in a row. Each trade goes into profit initially, maybe 1% in profit, but each time you lose 1%, and after 3 losing trades in a row, you've now lost 3%. When you could have easily just closed the trade when you were 1% in profit, which is how most new traders begin to think. So what do you think this does to a new trader? After realizing the last 3 trades, he could have closed each one 1% in profit and actually gained 3%. But now he's lost 3%. It forms bad habits because the trader then tells himself, the next time my trade goes 1% in profit, I'm closing out and taking profit. This is when the bad foundations are laid. Because let's say the 4th and 5th trade turn out to be winners, like the chart example below. So this particular trade here, normally based on your strategy, this particular trade would be a 1 to 4 risk to reward ratio. Therefore, you'd be risking 1%, which is the red zone, and your green zone would generally be 4%, which obviously would be larger than the red zone. But, based on, the previous trades you've taken, you've actually now decided to take this and take a quick profit. So you take profit at 1% because the last 3 trades went to 1%. But really, you should have just stuck to your strategy and rules because then this happens. Obviously, you've already closed this trade now at 1%. This is a perfect example which shows listening to your strategy and this trade being a 1 to 4, which means you gain 4%, which have actually covered your 3% losses and an additional 1%. Why hope has no place in Forex trading? Generally speaking, hope is not necessarily a bad thing. People have hope for many things within their life. They hope to pass an exam or a driving test. Hope is a desire for something combined with an anticipation of it happening. It is the anticipation of something desired. To hope for something is to make a claim about something significant to us, and so to make a claim about ourselves. One opposite of hope is fear, which is the desire for something not to happen, combined with an anticipation of it happening. Inherent in every hope is a fear, and in every fear a hope. Hope is similar to faith. It's an expression of confidence within life. Hope helps us get through maybe difficult times, as it makes it easier to look forward into the future. Obviously, the opposite of hopeful is hopefulness, which can be a negative feeling. For example, when you fail at something and you now feel hopeless. Hopefulness is a negative feeling, which generally is attached to depression, low mood, and low self-esteem. But even though being hopeful or hoping is meant to be a positive, it can also be painful because a desired circumstance or thing the person may be hoping for hasn't yet happened or may never happen. In my opinion, and my opinion only, hope is just not enough and it does not have a place at all within the financial markets. Just hoping for something doesn't really mean anything. I hope to get rich. I hope I win the lottery. There's no real logic or conviction behind it. Most people spend their entire life hoping for something, but do very little in terms of making a decision or acting logically to get it. They just hope and sway and blow through life like a plastic carrier bag, blowing in the wind with no real direction. I have never hoped for anything myself, I just did it and made it happen. I don't want to feel the positives or the negatives of hope within my life, so I simply do not hope for anything. I take action daily on what I have control over, which is my thoughts, feelings, and actions. In the chart example below, I want to show you how bad habits can be formed through the emotion of hope, how hoping is for the hopeless and can cause us to lose our entire accounts. So as you can see from the chart, you have placed your buy position, with your stop loss just below the recent wick, and you've also set your take profit level. You've done everything correctly according to your strategy, and the reward relative to risk within this trade has huge potential. Now you just sit and wait. As you can see from the second chart, after you placed your buy position, price began to move positively. Price then stalled and returned past your entry price and stopped you out. The moment the trade stopped you out, price aggressively moved to the upside and hit exactly where your take profit was set. How annoying. You had the market direction perfectly set up and your trade was near perfect if it wasn't for your stop loss which took you out of the trade. So next time you decide not to place a stop loss, or you decide to give it more room and do a bigger stop loss outside of your usual rules for stop loss placement, and you decide to go against your strategy and the rules you've set. The next chart example is of your next trade and one other example. On your next trade, you identify a level of resistance and decide to enter on the 4-hour bearish engulfing candlestick. Great job. You have decided in this trade to not place a stop loss, because last time the market basically came down to just below your entry, stopped you out, and then went where you thought it would go. So instead, you'll trust your analysis and hope it does what you want it to do. Even though the markets can be volatile and move fast, this trade has to be a sell. Price is now 63 pips above your entry price, but you stay hoping, because last time price did this, it then went in the direction you wanted. Price is now 132 pips above your entry price. No more hoping, this is just now panic. Looking over this example, say based on your strategy, you normally use a 30-40 pip stop loss. But now, because you did not define what your stop loss will be for this trade, which is the first thing you should do before entering, you had no idea what position size to use. Because your position size should always be calculated based on your stop loss size, which is covered in the risk and live trade management section. So because of this, you've just randomly chosen your position size, which happens to be too much, and you're now 132 pips in drawdown, which could be 5% or more of your account just lost on one single trade. People tend to hold on to the trade and keep holding till it gets out of control. How out of control they let it go is up to them, but either way, it's never a good choice. Why? Not using a stop loss keeps you in the trade and at risk of excessive drawdown and or a potential margin call. Not using a stop loss also puts your account in drawdown, which eats into your available margin to invest into other trades which may be provided better confidences or a better risk to reward ratio. Not using a stop loss and manually closing the position after it gets so out of control, you have a 5 to 10% drawdown on one trade. This knocks your self-confidence, forms bad habits and hurts you emotionally. Not using a stop loss also means you have to sit in the trade far too long in the hope it may come back to break even or an amount you're comfortable in losing. This does not always happen. Not using a stop loss also means when you do finally take the loss, it's more than what you usually lose, which is 1%, say for example. So you now need to work 10 times as hard to get your account back to where it was, which is more pressure than you need. This is another example of hope. In this example, you do everything correctly except one thing. You define your position size based on your stop loss, you define your target based on what you're willing to lose, and you have figured that this trade is a 1 to 5 risk to reward. Great. All of the confidences add up for a great buy decision, and no matter what happens, you know you will win this trade. At least you hope you do. This is your trade showing your buy position, stop loss, and take profit. The trade, once you'd opened a buy position, began doing very well. You pretty much went into instant profit. As price began to climb, suddenly it stopped and began retracing. As it was retracing, you began hoping it wouldn't break the trend line and hit your stop loss. Price began moving aggressively, so just before the trade broke through the trend line, you decided to move your stop loss because you were so sure that you were buying. So in the hope it would come back up, you decided to move your stop loss thinking maybe this candle is a fake out and it will pull back up above the trend line. Price keeps dropping and dropping, so you move your stop loss again, in the hope price is going to retrace back up, even if it could retrace back up enough just to get out a break even and the price you bought at. All these emotions are running through your mind. You're feeling a bit panicky right now because you knew you should have just let the price stop you out at 10 to 15 pips, but instead you're now sat in 30-40 pip drawdown, which is 3 times the amount you normally allow for based on your rules and strategy. You're sat just praying and hoping it doesn't drop anymore and wishing you had just stuck to the game plan. Really, you should have let it stop you out and taken the loss and moved on to the next trade at a 1% loss. Now you could end up taking a 4 to 5% loss. Price then shoots down and stops you out for 85 pip loss, which is 6 times more than the usual amount you allow for a stop loss based on your strategy, meaning you've now lost 6% of your account instead of 1%. During the emotional rollercoaster of holding this trade and being angry, you've probably missed 5 different trading opportunities within other markets which you could have profited from. Normally, when people are in big drawdown, they refuse to take any more trades until they either close the current loss out at break even or close the drawdown out in a more comfortable amount in which they are prepared to lose. When really, they should have just placed a stop and forgotten about it. Either being stopped out or winning the trade. That's the only 2 things which should happen with a trade. Either you get stopped out or you win. Because if you'd gotten stopped out for 1%, you could have then changed your bias on this particular pair and actually sold it for a 1 to 5 risk to reward and gained 5% profit, which would have covered your 1% loss plus an additional 4%. See the next chart example. So on your first trade, you were stopped out at 1% on the buy bias, but when you became adaptable to the market and saw a sell opportunity, you would have actually gained 5% on this particular trade. As you can already tell, it's so important to not have a fixed mindset when it comes to forex trading. You have to remain adaptable to changing market conditions because you can have 6 confidences to tell you to buy according to your strategy and rules, but the trade can still go the opposite way. This is why it's crucial to use a stop loss, because that way, believe it or not, the stop loss can be your best friend, looking out for you, taking you out of the trade and watching your back when the market isn't playing ball. The stop loss will get you out like it should. Sure, it's annoying when you get stopped out and then the trade goes the way you thought, but surely you'd rather this than holding a trade in excessive drawdown on the times actually price doesn't go the way you thought. Problems with excessive drawdown outside of normal risk conditions. Minimal drawdown is normal. If you're risking 1% per trade and you have 6 trades open, you might be in 0.5% drawdown on each trade. which is 3% drawdown combined. Not every trade the moment you buy or sell goes into instant profit, so you do need to allow for some normal drawdown. The real problem is excessive drawdown outside of your normal risk conditions, for example 20% drawdown, or with some well-known traders, 75% drawdown. Drawdown can seriously knock your confidence, cause you to lock up and freeze in fear, feel depressed, cause a lack of sleep through worry, prevent you from taking any additional trades, cause you to revenge trade, force new trades, and waste days and days when you could be more moving forwards with your life and your trading and simply taking a 1% loss. Most of the time, after you take the 1% loss, it doesn't actually feel that bad. You tend to just forget about it when you make your next 3 or 5% win. I hope you've enjoyed this video presentation and you have a better understanding on which mistakes you are making when it comes to the emotions of trading. Let's now move on to the next video.